Welcome to This Explainer. We're diving straight into the complex financial and structural realities currently operating beneath the surface of this massive AI boom. We hear a ton about the technology itself, but today we're really going to focus on the money, the infrastructure, and the hidden leverage driving the whole shebang. Let's get right into it. We've got to start with a truly massive number, $200 billion. That is the staggering amount completely wiped off the value of compute selling companies in a single day recently. And why? Well, because Meta simply signaled they might sell off some of their excess AI capacity. Just the hint, the mere suggestion that computing power might not be completely scarce sent absolute shockwaves through the market. And honestly, that market reaction makes perfect sense when you look at the mindset inside these companies right now. According to investors, Google co-founder Larry Page has internally expressed that he is, quote, willing to go bankrupt rather than lose this race. It's a high-stakes, almost desperate panic, driving an all-or-nothing arms race in Silicon Valley. Okay, here's our roadmap for today. 1. The first cracks appear. 2. Funding the AI build-out. 3. The hidden structural debt. 4. Physical limits and AI slop. 5. The good bubble argument. And 6. What happens next? All right, Section 1. The first cracks appear, from hype to reality. The sheer scale of the spending we're seeing is just astronomical. Alphabet's capital expenditure hit $45 billion in a single quarter. That more than doubles where they were a year ago, with full-year guidance raised to over $200 billion. This aggressive spending actually led Google's parent company to report negative free cash flow for the very first time since it was listed back in 2004. To fund all this, they're raising massive amounts, roughly $50 billion in equity and nearly $100 billion in debt this year alone. So they aren't just cash printing machines anymore. They are spending heavily just to keep pace. Now, there's also an immediate pressing threat to the premium AI giants. Companies like OpenAI and Anthropic are facing some serious pressure because cheaper, open-source Chinese models have arrived, and frankly, they're good enough to start taking customers away. These open-source alternatives are estimated to be only a few months behind the leading frontier models. So for a lot of businesses out there, the incentive to pay top dollar for incredibly expensive AI credits is shrinking fast. Section 2. Funding the AI build-out, the bond market shift. While everyone is obsessing over relatively modest stock market dips, the bond market is quietly sounding a massive alarm. Lenders are getting cold feet. The demand for bonds from hyperscalers, the massive cloud providers like Microsoft and Google, has fallen sharply. In fact, some long-dated bonds are now trading at spreads you'd normally associate with junk-rated debt. Even though these tech giants still hold top-tier credit ratings, the bond market is quietly pricing in severe risks that the major rating agencies simply haven't caught up to yet. Which brings us to Section 3, the hidden structural debt, the climax of the boom. Research estimates that off-balance sheet future obligations across the big five tech companies have reached a staggering $1.7 trillion. Trillion with a T. Think about it like this. When a company like Meta needs a new data center, they often don't build it directly. A separate company, sometimes part-owned by an asset manager, borrows the money and builds it. Meta is just the tenant. So the debt sits on someone else's books, meaning the true leverage driving this entire AI boom is actually much, much higher than their official balance sheets suggest. And this dynamic is exactly why Bloomberg compares today's AI debt structure to Enron, or maybe more aptly, the 2008 subprime crisis, rather than the 2000 dot-com bubble. See, the dot-com crash was mostly about simple overvaluation, but 2008, that was about hidden structural leverage. Remember, the subprime collapse didn't start when house prices plummeted. The entire system started weakening the moment prices merely stopped rising fast enough. Let's actually break down how this financial loop works step by step to see exactly how this leverage builds up. First, a hyperscaler built a data center. Then an AI lab like OpenAI signs a contract to pay for computing power over 5 years. The provider then treats this promise as guaranteed future revenue. But structurally, it's identical to a loan. Markets are seeing a backlog of hundreds of billions in guaranteed revenue, but that guarantee relies entirely on these AI labs maintaining exceptional, unprecedented growth to actually foot the bill. And the loop gets even tighter when we look at the chip makers. Take what we can call the NVIDIA loop. NVIDIA commits billions in investments to an AI lab. That AI lab then turns around and uses NVIDIA's backing as collateral to borrow billions from banks. And what do they do with that borrowed money? They spend it buying NVIDIA GPUs. NVIDIA books the revenue and the loop repeats. It strongly indicates that some of today's record demand for chips is essentially being manufactured by the very company selling them.
All right, Section 4, Physical Limits and AI Slop.
We are hitting some massive real-world physical limits with this build-out. To give you a sense of the scale we're talking about, one proposed data center campus would have a footprint the exact size of the city of Paris. The electricity and water demands for facilities like this are just absolutely enormous. Because of this, U.S. electricity prices are rising, and opposing new data centers is quickly becoming one of the very few issues actually uniting politicians across the political spectrum. Growth in new approvals is already starting to slow down. Then there's the consumer side of things. There is a massive gap between the hype and the current reality. Despite the billions and billions being poured into infrastructure, right now just over 2% of U.S. households actually pay for an AI subscription. Most people and businesses simply do not want to pay premium prices, especially after getting used to heavily subsidized early models. What we're seeing instead is a flood of what people are calling AI slop. Since AI agents became easily accessible, there's been a massive boom in mobile app releases. Yet the number of apps people actually use is falling. So we're getting way more stuff, but less overall value. Furthermore, businesses trying to use AI to replace human workers are finding out the hard way that the AI still makes mistakes. It requires heavy human oversight, which ends up keeping costs much higher than they originally anticipated. Now let's look at the other side, Section 5, the good bubble argument, the counter-narrative.
Because, to be completely fair, the bulls have a very strong case here. Unlike the subprime borrowers of 2008 who had very little actual income, today's hyperscalers still have enormous, undeniable cash flows. For instance, Google Cloud reporting 82% growth. That is real revenue, not just some future projection. Plus, some argue that the widening credit spreads in the bond market are simply a normal reaction to a single sector suddenly accounting for a quarter of all new investment-grade borrowing.
A lot of folks in the tech industry argue that even if this is a bubble, it's a good bubble. They compare it to the 1800s railway boom. During the railway rush, massive amounts of money were invested, and yeah, many individual firms went completely bust. But the foundational infrastructure, the train tracks, remained, and society benefited from them for centuries. The argument here is that the massive data centers being built today are our modern train tracks, and they will eventually benefit everyone, long after the financial dust settles.
Finally, Section 6, what happens next?
So you're going to want to keep your eyes firmly on 3 key indicators. First, watch the adoption of those cheaper, open-source Chinese models. If businesses flock to them, the premium AI labs are in real trouble. Second, keep an eye on rising borrowing costs. If lenders continue to get cold feet, the cost to build these data centers will absolutely crush profitability. And third, look for hyperscaler capex cuts. Meta admitting to excess capacity was the first crack. If another tech giant decides to cut their capital expenditure, well, it could change everything. I want to leave you with this final, provocative thought to ponder. As these pressures mount, how is Wall Street going to react? When the next earnings call happens, will the market reward a firm that shows financial discipline and cuts back on AI spending to save costs? Or is the fear of missing out so strong that there will be endless, limitless momentum to just keep investing more and more, no matter the price? Thank you for joining me for this explainer, and definitely keep a close eye on those numbers.